We have three fixed income investors here, fixed income asset managers, leaders in their fields. I should say immediately, just as blanket coverage, nothing that any of them says is investment advice, and nothing that any of them says is to be taken as representing a house view, but rather the individual view of the person concerned. So let me just introduce the panelists as you see them from left to right. Angus Bell is an executive director at Goldman Sachs Asset Management in London in the Global Fixed Income and Currency Investment Management Division. To my left, Nick Eisinger is Government Bond Strategy Man at Fixed Income Investment Management Group Europe at Vanguard, also based in London. And Gyula Tot is Senior Investment Manager at Macquarie Investment Management Austria, just around the corner. So welcome, gentlemen. Thank you. Just a quick sort of round the panel. AUM, Gyula, in this region in terms of fixed income?
Macquarie globally runs about 400 billion, and out of that in emerging market is less than 10% at the moment.
And of that 10% allocation to CEE?
Roughly one-third.
One-third, okay, right. Angus?
So in the Goldman Sachs Emerging Market Debt team, we're managing...
Are you on? Yeah, okay.
We're managing just under $48 billion, and I would estimate about 8 billion of that would be in this part of the world.
Okay, Nick?
We have about 8 billion in EM active globally, probably around a quarter of that to a third, depending if you include the MEA part of the EMEA region.
Okay, fine. Well, just to put people generally in the picture. Now, there was a audience poll question tied to this panel. I don't know if you've all looked at it. Can we get the question up on the screen? Okay, 2017 saw peak QE. At one point, aggregate central bank balance sheets growing by $2 trillion year on year. That number may be zero by the end of this year. So what do you say in response to that? A third of you say about time too, enough of market distortion. A third of you say run for cover, the crash is now. The answer that you can't quite see is worry not, a new surge of Chinese liquidity will keep markets pumped up. And then I don't believe it'll happen. Funny money's here forever, I think was how I wrote the question. So anyway, an interesting split, I suppose. Oh, right, no, okay. Can we read anything into what we're seeing, Nick? Does that tell you anything? What would you have voted?
First one, I think, is reasonable.
Okay.
It's good for investment, good for investors to have less funny money around. That doesn't mean the funny money is disappearing quickly. I think it's going to disappear in a managed and pretty well telegraphed manner. So there's still things to be done. But if volatility is going to creep up this year, it's probably the second half of the year. And I think that's good for risk markets.
Okay, Gyula?
Yeah, I agree with the first one is the right question to ask, although I don't think that the end of QE would necessarily mean huge trouble for emerging market fixed income. Emerging market fixed income is still structurally underallocated in global portfolios. We're talking about countries which represent more than 50% of global GDP, yet less than 10% is allocated into emerging market fixed income and equities in global portfolios. So I think it's QE ending is certainly something to talk about, but it's not going to be a game changer for structural allocations into the asset class.
And do we all agree that by the end of this year, QE, in terms of the flow, will have ended, in terms of the increase?
Yeah, there is definitely a risk of that.
Risk?
It can happen. It's not far from certain. I mean, the big question mark for us is what the ECB is going to do.
Yeah.
And when and how they will exit their QE program. But if you look at the way inflation is behaving in the Eurozone, there might be a need to end it relatively soon.
What do you think, Angus?
Well, the only other thing that I'd add to this theme, which is obviously getting asked a lot around the world, and I think if you were to ask that question to a panel almost in every corner of the world, they'd probably answer in a pretty similar way, which I think speaks to Nick's point. Central banks and markets generally are very, very aware of this theme, and why that's so important clearly is that the ability for that particular thematic to completely derail asset markets and create some type of a negative event of this risk, I think, is reasonably well controlled.
It's interesting that 12% of the audience still don't think it's going to happen, 11%. And there is, surely, whether you call that a risk or not, but there is a possibility, isn't there, that there's a lot of fine talk about ending the era of funny money, but actually they'll find a way not to.
I think central banks understand the importance of removing that liquidity provision in an orderly and well-controlled manner, because it's obviously been in place for such a significant period of time now. They've been very, very careful in keeping that in place in order to effectively see the whites of the eyes in the economic recovery that we're seeing around the world, and that's certainly now what we're getting. I think they'll be reluctant to repeat some of the mistakes that have been made in the past, going back several decades, where liquidity removal has been implemented too quickly.
So the central banks have done a good job since the crisis, and we expect them to continue to. Quite benign.
I think so. I mean, there's a tail risk, of course, and if the degree to which we've seen a flattening of the US yield curve over the past 2-3 months, at some stage that will need to unwind. That'll have different implications for different parts of the EM asset class, be it local currency government bonds, or be it hard currency, and be it FX. But let's not forget, we're talking in a forum here where I think we invest across the spectrum in local and hard currency, and obviously in FX and corporates. So if you think a little bit about the dynamic for local bonds, now there's certain central banks across the EM spectrum which actually should be quite immune to some degree of G7 monetary tightening. Russia is definitely one of those, with pretty high real interest rates still. I think that's quite nicely insulated from the general central bank balance sheet unwind that we expect this year. I think there's one or two other countries, Brazil certainly in Latin America would be another one that would be part of that. So you can construct an argument where actually investing in certain portions of the EM local currency space provides you with a nice hedge or a nice insulation from what's going on in the sort of G7 part of that. I think CEE is probably less insulated from that, particularly the likes of Hungary. Obviously, we've started to see the Czech Republic already start to tighten monetary policy. So CEE, because of its sort of proximity to the Eurozone and the degree to which interest rates have been so drastically cut over the past couple of years, is probably less of a compelling local government or local rates trade for 2018 than places like Russia, places like Brazil, very possibly South Africa, and one or two others.
Gilo, we just heard mention now of Russia and Brazil as well as the sort of core countries we're focused on here. Let's just sort of step back a little bit. In the current environment, the case for investing in emerging markets in general and CEE in particular, obviously there's going to be slight differences there, but some considerable overlap. Given the strength of prices in equities, in bonds, real estate, even Bitcoin, and the low volatility, and the fact that all of those ramping markets seem to have been entirely immune to some very clear political risks and worries, any way you like. I mean, you can take your pick of those kinds of things. Against that backdrop of sort of markets defying political reality, if you like, or defying world events, how do you view the case now? You've already made the point about the limited allocation to emerging markets in vis-a-vis their share of GDP. What is your more general point about investing in emerging markets and CE in particular? And then I'll ask each of you to comment on that as well. But you first, Gilo.
Yeah, I mean, from our side, if you look at the world and you look at the asset classes which you just mentioned, there is a lot of argument for overvaluation in many asset classes. But if you want to look at emerging markets specifically, if you look at valuations there, it's difficult to argue that it's an extremely overvalued asset class, be it local currency, hard currency, or even on equities, which had a tremendous year last year, and very, very strong first 2 weeks of this year. We do think that local markets are still very, very attractive. I agree with your points. In terms of the CE region, we also agree that this is the region which probably is most at risk from higher G7 rates, simply because central banks pushed rates at extremely low levels. But at the same time, we mustn't forget that there is a currency component in CE, and these countries and currencies benefit a lot from the very strong Eurozone backdrop. So there might be a case for a short duration allocation in the region, but there could be a very compelling case for long currency exposure in the region, because these currencies are still fundamentally very undervalued. We are in a Eurozone and proxy to the Eurozone, which is showing growth numbers we've never seen in the last 10 years, very, very synchronized growth. And in this region, Czech Republic, Hungary, all the other countries, you have a very high share of export into the Eurozone. And yet these currencies still offer value in our view.
Angus, your case for EM investment generally and CEEM investment in particular?
Sure. So I think the synchronized upswing in global growth that we've certainly got a lot more evidence of in the last 6 months will provide a conducive backdrop generally for continued performance for emerging market assets. I take the point that some of them have already moved quite a lot, and there's certainly areas of the broader landscape that perhaps appear less compelling from a valuation perspective. Certainly agree with the points. I think EM local continues to stand out as probably being the most compelling in the space, and against that backdrop, we can also see room for further appreciation from EMFX generally relative to the dollar. I think in particular for this region, I think one of the key areas that's sort of driven this improvement in growth has come from obviously this recovery story that we're seeing within the Eurozone, and obviously the proximity of these economies to that pickup in growth after a long period of relatively stagnant economic performance will certainly be of benefit. And then there's some complications related to that transmission of that. Obviously, the growth is picking up against a backdrop where in many economies inflation is still relatively low, although it is picking up. And as much as there's been certain focus on things such as the Phillips curve from various developed market central banks over the course of the past 12 to 18 months, there's plenty of evidence in certain Eastern European economies that the Phillips curve is certainly alive and well. And that is creating some interesting opportunities for us to be certainly tactically positioning our portfolios where we've got preferences for some countries versus others, both on the local rate side and the currency side.
Nick, anything to add to that? But as well as that, you've each actually brought up in slightly different contexts the correlation for CEE with the Eurozone for obvious macroeconomic, trade, commercial reasons. Obviously, traditionally, one of the principal attractions of EM investment is that it's uncorrelated with other aspects of one's portfolio. So comment on what the others have said, give us your own view on CE in general, but also then take us into that correlation point.
Of course. Well, clearly the fundamental outlook is strong globally, as well as in EM. Pockets of idiosyncratic risk, obviously, around the world, places like Venezuela, one or two others come to mind, but generally speaking, we're among some of the best fundamentals we've had for a little while. Technicals are pretty good, both in local currency and hard currency. Inflows continue to come into the asset class. We actually think that local currency inflows will be stronger this year than they were in 2017. There's some catch-up to play there. The big bugbear here is that valuations are tight, certainly in credit. And so the way I think about this is how do you sort of attribute your performance in a portfolio? One is obviously your call on the asset class overall. If you're running a global portfolio, European credit, US high yield, EM. The second within that is obviously what part of EM do you wish to be over or underweight in, rates, frontier, credit, and so on. Country selection, usually that will form a relatively important part of any active investor's overall attribution. And a reasonably important part for us is indeed country selection or country calls, if you like. But really where you can really make hay and effectively in the parlance of our industry increase your information ratios is in your relative value calls. So that's all about security selection, issuers and issues, where in a capital structure you want to be, how you trade the curve, do you trade basis, in other words, do you do cash against CDS? And we find that that element of focusing in your portfolio, rather than necessarily trying to make a huge call on whether the Central Bank of Turkey is going to raise rates by 300 basis points in the next 2 months, which they might, but they might not. Focusing on that relative value part really can enhance your sort of risk attributes and as I say, your information ratio and ultimately deliver pretty superior asset class returns. I mean, in terms of the correlations, I'd probably slightly rephrase it. The correlations are different. They're not necessarily always lower. You know, and again, your starting point really should be what happens with the US Treasury curve and what happens with global growth. Clearly, if there is downside to global growth, your higher beta markets, places like Ukraine, staying in the region, you know, are going to suffer much more from a global growth downturn. If there's a fairly modest rise in the US Treasury market and more or less, I'd say, in line with how the market prices things at the moment, then generally speaking, EM should be able to absorb the vast majority of that. I think actually the lower beta names, of which there's many in Central and East Europe, probably can absorb that Treasury increase less well than the high yield names. Not because there's risk within those countries, but purely because the credit spread inherent within names like Poland and Hungary is so much smaller, and therefore, you know, it has a lot further to absorb in terms of taking on that additional Treasury risk. Whereas actually, if you then look at the high yielder stories, provided they're good stories, they have a narrative to them. You know, there's something happening. There's an IMF program on the way, or they're in the middle of an IMF program. Under that more benign scenario for 2018, those countries can continue to perform pretty well. And actually, just finishing up here, when you think about how you trade the curve in credit, with those high yield names, you want to have convexity in your portfolio, meaning you want to own the longest dated bonds possible at the right price. So I'll give you an example that I'm sure I've given in various forums before over the past year, but you know, Argentina, as many of us know, again, straying off the region, but you know, they did a 100-year bond last year. And lots of people in the press were horrified at this. How can Argentina issue a 100-year debt, and haven't they defaulted on a perennial basis? But actually, the duration of that bond was not that different to the duration of their existing 30-year bonds, and you were being paid to take that risk, certainly at the time of that new issue. So that was one of the best trades to have done at that particular time. And that's what I mean by duration. It means longer dated bonds get mispriced, there's too much risk premium embedded in that part of the curve, and they have a good story. And you know, maybe the good story in Argentina will start to fade later on this year, but certainly it was in its renaissance in 2017.
Do you like century bonds, Angus?
We certainly did participate in that issue as well.
Yeah.
So, you know, I think this is one of the things.
It's a good and impressive story, and the politics is going the right way.
Politics are certainly heading in the right direction. Argentina has been growing at a relatively slow rate for a number of years, and we're quite positive in terms of the the growth trajectory accelerating.
Well, it was out of the market for 12 years, essentially, so they've got a long way to go before they are overburdened. Talking about valuations, which you have done, just before we come on to another topic, something that caught my eye the other day is how Greek 10-year bonds have come in to now yielding something like 360, with US 10 years yielding 250 or something. I mean, can you see Greece trading inside the US?
It does, actually, in the short end.
It does.
Yeah. Really?
Short-end bonds are inside.
Yeah.
That is weird, isn't it? Not being rude in any sense about my dear friends in Greece, but...
Well, you know, the market works quickly to price in default probabilities on a forward-looking basis. So, I think we can't get too caught up on what's happened, even if it's in the recent past, and need to focus on looking forward and the improvements getting made. I think the other interesting instance that I would say, Macedonia came to the market already this year. And on that theme that you were talking about regarding sort of the connectivity with Europe and the correlation that many of these economies in this part of the world have with what's happening in core Europe, Macedonia is a good example where I think almost 50% of its exports actually go to Germany. But if you actually look where Macedonia stacks up on the world ranking in terms of ease of doing business, it's at number 10. And as a result of that, what's essentially taken place in that economy over recent years is that there's been this significant amount of investment from large European countries and corporates that are integrating their value chains further east. And I think when we think about that connectivity with Europe, it may have been a curse if you rewind 10 years ago, but certainly at this current juncture,
it looks like a good thing. Yeah. I mean, talking about Greece coming in by 200. Let's talk for a moment about volatility. We've been in a very low volatility kind of environment. Do you see risks to that? Do you see the return of volatility in 2018, which was talked about quite a bit last year, but so far failed to materialize? Angus, again?
Well, I think there's a number of arguments around why volatility has been low, and I think what we need to focus on is really how quickly those arguments are likely to reverse or subside. One of the key things, of course, is that in an environment where global growth is improving and there's a synchronous improvement in most regions around the world in global growth, it makes sense to us why volatility levels actually should be reasonably low. Now, they're obviously exceptionally low, and we can see perhaps some shift higher back to closer to average levels, but there's, I think, plenty of good reason in this current environment why risk asset volatility is controlled.
Volatility, comment on that?
Yeah, I mean, there is, of course, a lot of focus on volatility, but one mustn't forget that implied volatility or volatility reflects the reality that realized volatility is very low. So it's low because the global growth is synchronized, and that is reflected in implied volatilities. Implied volatility, for me, doesn't suggest that a market is too complacent. It just reflects that the realized volatility is too low. So I think what those arguments, which suggest that volatility will spike up because the market is too complacent, are somehow, I disagree with those views. In terms of the end of QE, and it will introduce a lot of volatility, I would highlight that during the last Fed tightening cycle, actually implied volatility in fixed income space declined. Why is that? Because what investors and funds and asset allocators don't like is uncertainty. If the Fed is very well telegraphed what is going to do, ECB is facing a communication challenge, but once the QE unwind is happening, it's not necessarily negative for volatility. It's not necessarily will push volatility higher because it's very well telegraphed.
Okay,
ECB is facing this challenge from its own perspective. We hope it will not make a mistake with that, be it like 2013 when the Fed announced the taper out of the blue. That was a good lesson. And I think ECB learned from it a lot.
So vol is low for good reasons. Before we leave that topic, I just want to ask you really quickly, and you've each mentioned possible examples. You mentioned Venezuela. To what extent does, given that you don't, it's not complacency, it's synchronized growth, and there's all good, solid reasons behind what we see, to what extent does political risk feed into your country choices, Gyula?
Yeah, it does have an implication, but for us, what is more important is the structural institutional framework a country operates in. For example, for this region, especially for the EU members, that is a very solid institutional framework, which a lot of countries can try to test it one way or the others. But as long as they are a member of the EU, it's difficult to sort of get overly worried about the political noise. It's part of the game. It's part of the usual election cycles in many countries. But as long as they are EU, the institutional framework is strong enough that...
So it's not a huge part of your asset allocation?
For this region, not necessarily. In others where there is no EU anchor, of course you have to go deeper in to understand. The places like Brazil, Mexico will have elections later this year, Argentina, and those countries you really have to go deep down and try to understand what is driving politics. Because politics on its own is not necessarily a bad thing. Why is it important? Because what influence it could have on central bank policy, what influence it could have on fiscal policy.
Nick?
Yeah, I agree. I mean, generally speaking, when the macro outlook is good and stable, politics really doesn't matter. West European politics, Italian elections, not a problem at this stage. Generally speaking, in this region, I would argue that because the macro outlook remains good, politics is not really a problem in the near term, at least. Obviously, there are parts of the world where politics does feature a lot more. Venezuela is very clearly one, but you're buying these bonds at 30 cents on the dollar, so that's fine. You're being paid for that. You're being paid to take that risk. You know, South Africa's been a very interesting exercise in trying to understand political risk with the recent ANC elections in December. That, to be honest, was a hard call because it wasn't obvious until right at the last moment who was going to win. And it's still not entirely obvious what the full outcome of that really will be. So often in a place like South Africa, you do get worried about the politics because the macro numbers in that country are also very weak. So those two things kind of coincide with each other. But I think as a global phenomenon, yes, there's elections in 2018. Yes, there's stuff going on in the White House that we all know about. But in the end, it's not a material source of risk for us.
In the end, is the economy stupid?
I think so.
Do you agree? I mean, at least as far as this region is concerned, politics is a dead letter?
You know, I think we're always watching closely, you know, to the point around assessing institutional quality and looking for any drifts in the direction there. And you know, I think there's certainly been some changes in certain countries in this part of the world, particularly Poland, with what's happening regarding the judiciary system there that is getting, you know, rightfully a degree of attention. But I think broadly for emerging markets, I'd agree. You know, politics is something that we as investors in emerging markets just have to accept and embrace, frankly. There's more than 70 countries in our opportunity set, and by definition, that typically means there's an election almost every week.
And after all, there is politics in DM as well. I mean, the man who was on this stage last year, who was a good old friend of mine, Jerome Booth, is very fond of saying there's no difference between emerging markets and developed markets. It's just that in emerging markets, you get paid to take the risk, and in developed markets, you don't, which is not a bad way of putting things into perspective, I think. Let's talk about indices, crucial part of market architecture. We all use them, we all benchmark against them, we all follow them, yet at the same time, and you invest in them, Vanguard. But we all agree that they are imperfect, almost by their very nature imperfect. I mean, for example, Estonia is rated AA by S&P, and it's not even in the emerging markets indices, it's in the frontier markets indices. How do you view, are indices intellectually coherent? And even if you say they're not, do we still need them anyway?
So, I mean, the Estonia example is a good one, I think, to just try and call out why it's important for investors to understand the difference between the equity universe and the fixed income universe. I mean, the reason why Estonia is not in the fixed income index is that it has such very small levels of debt. I think it's got less than 10% of GDP in debt, and it's obviously a relatively small economy, so it doesn't feature. I think generally the question about the importance of indices still very much remains. There's also big differences between the industry composition between, you know, the traditional hard currency emerging market benchmark and the local currency benchmark. And just the nature of the greater degree of concentration in the local currency benchmark, certainly to us, has presented very interesting opportunities when countries either get added or removed, just because there's generally you know, some technical pressures associated with the flow, either in or out. The Czech Republic was a great example earlier last year, with you know, a reasonably small economy that was starting to run hotter and hotter. And obviously the inclusion by JP Morgan into their local bond index created this technical flow impact that you know, was going to be a challenge for the central bank to absorb, and that was obviously taking place at a similar time when the bank moved away from its exchange rate fixing structure.
I'll turn to you in a second because there's a particular indices question with you, but Euler, indices, imperfect but needed? Or?
Imperfect and needed, and in fixed income it's especially a very strange concept, especially the point you mentioned. By nature, fixed income indices are constructed as a market size weighted or market capitalization weighted. What it means that the investors who are following index very, very closely are inherently investing into highly indebted countries which have a lot of debt, a lot of outstanding debt. Whereby like a country like Estonia, which did the good job, they don't have debt, solid credit, is not part of the index because it did the good things. Whereby you have places like Turkey, South Africa, Mexico, all the highly indebted countries, with a very significant weight in the index. So that's inherently part of the fixed income index
You
construction.
could almost say that countries are rewarded for inherent failures in economic policy.
Exactly. That's the point. Even in global fixed income, when I said the allocation is less than 10% in emerging markets, a lot of investors are not allocating into emerging markets because their index tells them that they have to buy German bonds or whatever highly indebted country bonds. Just a comparison. Germany public debt to GDP is higher than most emerging market countries' public debt to GDP. The way index is constructed in emerging market countries, especially on the local side, is extremely concentrated on the wrong way, on the wrong side. And that's something to keep in mind. When we are talking about the JP Morgan index, the local index, it has less than 20 countries in it. Whereby in emerging markets, in reality, we are talking about more than 100 countries, which would be available and qualify as emerging markets. And there are tremendous opportunities out there, especially in those segments. The likes of Egypt, the likes of Ghana, and you name it, even for this region, Georgia, Kazakhstan. They're all huge countries, huge GDP contribution to the world, huge oil reserves in Kazakhstan, yet not part of the index. It's this type of index construction, especially for the local one, is very, very...
So do you propose any kind of remedy for that, or is it just something that the market has to live with, that they're imperfect, and you have to sort of invest around them almost, or sort of, drive around the problem?
Well, you choose, right? I mean, a couple of things when you think about indices. I think they are important parts of financial architecture, and they will be. I mean, in fixed income, most of the flows that have gone into the industry in the past 2 years have been in index product. There's a couple of reasons for that. One is it's cheap. The first and only real thing you can all do as investors is control what you pay for your investment, right? Massively important. Compound that difference over time, it makes a huge, huge difference to what you're getting at the end of that cycle. Secondly, you also have to ask the question, can your active manager or someone not investing in indices reasonably or realistically beat those indices over a 10-year cycle, consistently, after costs? Quite often the answer to that will be no. Now, I'm an active person, so I kind of see this from both sides. I think certainly in hard currency space, in emerging markets, certainly in developed fixed income, there's a role for both. I think you put some of your money into the index product, and then you find a good active manager. You find an active manager at low cost, very important. Still a good manager though, and you also make an active decision. You can have both running in parallel, and I think that can represent a pretty interesting optimal investment outcome for many, many people and institutions. Certainly, there's some flaws in terms of how some of these indices are put together. I would definitely echo the view from my colleague here on the local side. I think local fixed income in emerging market governments is a much harder prospect on the index side. I think it's much more easily lendable to an active product because, as you said, you're being excluded from all these different opportunity sets and so on and so forth. So I think that's much more of an active product, but the others aren't.
Not wishing to fall into the trap of being the sort of Cartesian philosopher who says it may well work in practice, but it doesn't work in theory, so I don't like it. Is a healthy degree of active management in a market necessary and indeed is essential for there even to be a meaningful way of investing passively? So what I mean is, does a tipping point come where if the move towards passive continues at the current rate of travel, will it almost kind of defeat itself because there is insufficient actively managed activity in the market to generate a market?
Yeah, so that's certainly getting into the philosophical space.
Well, we're about to have lunch, so a little bit of brain food before.
When I think about the emerging market opportunity set, to the point that a lot of the flows that we've seen into broader fixed income over recent years, there's been a concentration towards index products. It was interesting to me, at least, to see the flows last year into EMD. It was one of the few asset classes where the share of ETF flows actually fell. If you think about the opportunity set, which we just described, of consisting of more than 100 countries, there's naturally going to be a whole lot of inefficiencies with such a broad and diverse opportunity set. And I'm not saying every active manager is going to be able to outperform, but if you look across the space, the bigger, the better, the more consistent managers have proven.
10-year outperformance, the thing that Nick says is fanciful?
GSAM's been managing an emerging market debt portfolio for 18 years, and we've outperformed 16 of those 18 years.
Okay, but you're Goldman Sachs.
But the point is, like, the final point I'll make here is that the analysis we do on the Czech Republic, for example, that we did last year, we want to be able to buy into that before it gets added to the index.
Yeah, you want to trade these. Absolutely. For an active manager, trading and understanding what's coming in and out of an index is a very important part of generating your alpha and your excess returns. No doubt.
So you can arbitrage index inclusion, essentially.
Yeah, I suppose you could call it arbitrage, but this is all public information.
So if you know something's going into an index, you know that a whole load of people are going to have to buy it that didn't own it before. So you know, yeah. Okay, just a couple of minutes left. I've got one last question which will require a quick answer from each of the panelists. But there's anybody in the audience that wants to ask anything at this point? Just a quick question if there is one. Oh, there's a gentleman just there. George, can you get him the mic? You can just shout if you like. It's often better. Or whistle.
Good morning. I'm Daniel Kozela. I work for General Investments. I've got a specific question regarding this region.
Regarding what, sorry?
Regarding this region.
Oh, this
CEE.
region, sorry.
I'm quite puzzled by behavior of two important central banks, of the Czech Central Bank and Hungarian Central Bank. These two economies are in the same stage of the business cycle. Output gap is closed. Core inflation is creeping higher. Current account surplus is in place. But Czech Central Bank is tightening its policy, whereas we can see that the Hungarians are adding accommodation. What do you think is behind the development? Is it just a different timing of turnaround in monetary policy, or is it the beginning of a monetary policy error?
Okay,
thanks.
Tempted to put that question to a Hungarian. If only we had one. Oh, we have got one.
Yeah, I mean, if I look at the track record of the Czech National Bank, for me, this is the central bank, which is the best track record by far in this region. This was the central bank in 2008, which way before ECB was still hiking interest rates, running directly into the great financial crisis. The Czech Central Bank has a tendency of sort of seeing the world somehow very well, and they were the only one who started cutting interest rates before the crisis started. So for me, what the Czech Central Bank is doing makes perfect sense, what they're doing. It reflects their business cycle very well. They're growing very strong, wages are growing very, very strongly, and they need to tighten monetary policy. They obviously have to balance with the currency appreciations. Czech Republic received a lot of portfolio inflows because of the PEG was in place, and this money is still in the market, so they have to balance it. For me, Hungary is kind of maybe 2 years behind the Czech cycle in terms of being too worried about the currency appreciations. And to avoid that currency appreciations, the central bank seems to do everything possible not to have a currency appreciating. I think all the measures that they are implementing these days, and we'll have the first interest rate swap auction later this week, is focusing on the currency side. The currency should not appreciate too much, and they are overly focusing on it. But I think at the end of the day, the business cycles are very similar. Wages are growing very, very strongly, and sooner or later, the central bank will have to tighten monetary policy, also in Hungary, but maybe with 1 or 2 years lag than the Czech National Bank. And the Hungarian central bank was criticized for a lot of things, why it cut interest rates so deep, why it did this and that. over the last couple of years, they introduced they call it unorthodox monetary policy background, but at the end of the day, they were right. They got the currency not too strong, they have growth, they have inflation still under control. I think it will increase quite rapidly going forward, but they were right with that. So I think there is a time lag between the two.
Okay. Angus, very quick answer from you on that. You were talking about Czech Republic in your study of the Czech Republic.
Yeah, no, I mean, when it comes to Hungary, I don't have too many additional thoughts to add there. You know, clearly they're facing this challenge where inflows into the economy are tremendously strong. They're running a current account surplus, and that's further exacerbated by euro transfers. And so clearly the central bank's concerned that that if they start to increase the interest rate differential against the rest of Europe, then that will just create this spiral that's then more difficult for them to wind back in the future.
Okay, now, really quickly, notwithstanding that not one of these gentlemen is giving investment advice, I want to ask each of them in 2 words to give me a long-short pair that they like. Any asset class, any geography, could be Bitcoin versus coal, whatever you like. Nick.
Well, we'll stay with this theme here. Long Czech crown, short Hungarian 10-year rates.
Okay. Angus?
We like owning Russia local rates, and we would be short Mexico.
Short Mexico. Euler?
We like long frontier markets, non-index markets in general, against index markets in local.
Okay, good. They all had an answer, a pithy and no doubt valuable answer. You can all go and call your brokers before lunch. Ladies and gentlemen, thank you very much for joining us, and help me thank these excellent panelists. Thanks, guys.